A wealthy person can walk into a dealership, buy a $300,000 car in cash, and drive away. But many do not. Not because they cannot afford it, because the real question is not, do I have $300,000? It is, what is the smartest thing for that $300,000 to be doing? That is the first difference between buying a luxury car when you are rich and buying one when the car itself is the financial goal. For some wealthy buyers, paying cash is still the best move. It is simple. No monthly payment, no interest, no lender, no financing paperwork. You own the car immediately. If the person has plenty of liquid cash and does not care about keeping that money invested elsewhere, cash can make perfect sense. But wealthy people usually think about opportunity cost. Suppose someone wants a $300,000 car. They could take $300,000 out of an investment account and pay for the car today. Or they could put down a smaller amount, finance the rest, and keep more money invested. The second option only makes sense if the full cost of borrowing is low enough compared with what that money could reasonably earn elsewhere after taxes and risk. That last part matters. If the car loan costs 7% and the investment might earn 8%, that is not automatically a smart trade. The investment return is not guaranteed. The loan payment is. So wealthy buyers who use financing are not creating free money. They are deciding that keeping liquidity has more value than eliminating the debt immediately. And lenders may like them because loan pricing depends on things such as credit history, income, debt, the loan amount, the term, and the down payment. That can give a high-income buyer with strong credit more financing options. Then there is leasing. Leasing is especially attractive to people who want a new luxury car every 2 or 3 years. Instead of buying the entire vehicle and later worrying about selling it, the customer is mostly paying for the car's expected depreciation during the lease period, plus financing charges, taxes, and fees. At the end, they can return it and move into something new. For someone who always wants the newest S-Class, Range Rover, Porsche, or Bentley, that convenience can matter more than long-term ownership. But leasing has its own costs. Mileage limits matter. Damage can matter. Early termination can be expensive, and luxury cars can depreciate brutally. The buyer is not escaping depreciation. The lease is simply packaging that depreciation into a predictable contract. Now we get to the strategy that gets misunderstood online: buying the car through a business. You will hear people say, rich people just put the car under the company and write the whole thing off. That is not how it works. If a vehicle is genuinely used for business, the business portion of certain costs may qualify for tax deductions, but personal driving does not magically become a business expense because an LLC owns the keys. The Internal Revenue Service requires the deduction to reflect actual qualified business use. And expensive passenger vehicles are also subject to depreciation limits. If the car is leased, only the business-related portion of eligible lease costs can generally be deducted, and additional limits can apply. So a business-owned luxury car is not a free car. It is still money leaving the business. A tax deduction may reduce taxable income. It does not erase the purchase price. That difference is huge. There is another method available to some genuinely wealthy investors. Instead of selling investments to raise cash, they may borrow against part of an investment portfolio. This is called securities-backed lending. The logic is simple. If you own a large portfolio of stocks, bonds, or funds, a lender may allow you to use those assets as collateral for a line of credit. That can give the borrower cash without immediately selling the investments. And because the investments were not sold, the borrower may avoid triggering a capital gain at that moment. That sounds perfect. It is not. If the value of the investments falls, the lender can demand more collateral or repayment. If the borrower cannot provide it, securities may be sold. So the rich person who borrows against a portfolio to buy a car has added market risk to the purchase. A falling stock market can suddenly turn a comfortable luxury purchase into a liquidity problem. This is why sophisticated wealth does not mean borrowing as much as possible. It means understanding exactly what asset is backing every liability. Then there is the collector end of the market. A normal luxury sedan is usually a depreciating asset. A rare Ferrari, Porsche, McLaren, or another limited production car can behave differently. Some become more valuable. Some do not. Scarcity, specification, ownership history, mileage, condition, demand, and the broader collector market all matter. A wealthy collector may therefore think about the car partly as an asset. But calling every exotic car an investment is dangerous. Insurance is expensive. Maintenance can be enormous. Storage costs money. Taxes and registration cost money. One accident can damage collectability. And a market that is hot today can cool tomorrow. The wealthy buyer who understands this is not asking, "Will this car definitely go up?" They are asking, "If this car loses value, can I still comfortably afford to own it?" That is probably the biggest difference of all. A person who can truly afford a luxury car is not only able to make the payment, they can absorb the depreciation, the insurance, the maintenance, the tires, the registration, the storage, the interest if there is a loan, and the opportunity cost of the money tied up in the car. Take a $250,000 exotic. The purchase price is only the entrance fee. A major service can cost thousands. A set of specialty tires can cost thousands. Insurance can be dramatically higher than on a normal car. Drive it heavily and the resale value may fall. Do not drive it enough and you are paying huge money to store an object. That is why the richest buyer in the showroom is not always the person who writes the biggest check. Sometimes it is the person who has already decided where the cash should come from, what the money could earn elsewhere, how long the car will be kept, what the exit strategy is, and how much value could disappear without affecting their life. So how do rich people buy luxury cars? Some pay cash, some finance, some lease, some buy through a legitimate business, some borrow against other assets. Collectors may treat certain cars as part passion, part asset. There is no single secret method. The real advantage is optionality. When you have enough capital, you can choose the structure that best protects your liquidity, fits your taxes, matches how long you want the car, and keeps the risk small compared with your total wealth. That is the part social media usually misses. Being rich does not make the car cheaper. It gives you more ways to decide how you want to pay for it. And real wealth is not proving you can afford the car. It is making sure the car never gets the power to control the rest of your money.